So if you could please put your hands together as I welcome to the stage Dr. Ifeanyi Uba, the Head of Investment Research at Comercio Partners. Thank you so much. Please keep clapping. He's making his way to the front. Thank you so much.
Thank you very much. Wow, it's going to be very difficult to, stand on the shoulders of our DG. Thank you very much for your brilliant presentation. You really set the stage for me. So, I'm going to start and try and stick to time, even if it's going to be a very pressing task, given that the full report is almost 300 pages and this is just a concise version. So, I'm going to start with the hits and misses of our last report. I think it's very honest that we take it from there, because this is not the first time Commercial Partners is releasing an outlook, and our projections, even though they are spot on, could be a little bit off. So to start this, I'll tell a story of Francis Gallatin. And since we have most economists in the house, I'm sure you guys must have heard about him reading Gujarati or something. But Francis Gallatin was the person that pioneered the regression analysis, and he did it in a simple way. He went to a prize-winning contest for a bull and asked everybody, so let's just say there are like 10,000 people, 20,000 people. He asked everybody this simple question: what is the weight of the prize-winning bull? It's like going to a full stadium and asking everybody in the stage, what is the height of Ronaldo? Some people might tell you, oh, he's 10 feet. Some people will tell you he's 4 feet. But what he did was amazing. Immediately, he took the weighted average of every result. He found out that they were exactly correct and off by 0.5%. That's where we get the confidence level for economics. And it shows you that in this world of economics, we don't just do guesswork. There's a bit of analysis to it. There's a bit of finesse. And 1,000 years or 100 years past Francis Gallatin, I was so happy hearing the DG talk about stochastic models and how we have advanced from just simple regression to things that can make us predict. So let's move on. So, from our last report, we anticipated that the GDP was going to go as high as 5%. And this week, we found out that the GDP even went down from the previous paint after the rebasing. Although there's a huge increase in what we saw, what we didn't account for was the devaluation of the currency. So even if in Naira terms, the GDP increased massively, it needed to account for that devaluation that made our projection off slightly. But what we did get was the fact that the inflation came within the 20 to 15% levels, and current inflation for half year was around 22%, so off by 2.5%, which was definitely clear. Projection said that the Naira was going to trade around 1,700. Even though we have seen an appreciation, we're still going to talk about that. Some of the projections were off, where we're going to see a cut. The anticipated cut was because of the narrative pre the Donald Trump era, but nobody accounted for the tariffs and the tariff shocks. And if we did, our projections were a little bit off. But gold definitely surpassed our projections. Oil hit our mark and even went down and is trading around this region as we speak. So we have lots to do. So this means that you should pay attention to our projections very closely, because some of them might hit and sometimes some of them might miss. So we go for the global outlook. The uncertainty. So what we noticed was that there is fear of recession in the United States, the big economy that most people follow, and how it trickles down to the other economies due to our globalized world. But one thing we noticed was that the recessive fears might not necessarily be where we are looking at, because even with the tariffs and all the shocks, we still see the economy trading above areas that we require, that we consider recessive. And we still see confidence in the United States economy, unlike other times like the 2008 or the COVID-19 crisis. We still see the United States going above the recessive level when you consider the matrix of growth. And another thing we noticed was the convergence between the private debt and the public debt. So with the data seen, we are seeing that there's a little bit of convergence. Obviously, we have seen that private debt has always surpassed public debt in the United States. But recent data from where we could find it showed that the margins is getting smaller and smaller, showing that the private debt in the United States is now being less than public debt, and showing that the United States might be propped up by the government. The non-farm payroll recently alluded to it, where we saw a decrease in the private sector, but a massive increase, more than 5 times increase in the public sector non-farm payroll, showing that the economy might be increasing but might be propped up by massive government expenditure. And we see it in the charts, debt to GDP ratio for the United States ballooning to 120, and we see yields going to as high as 42 or 4.2. It almost hit 4.6, 4.6 around February, but now has trickled down. Now things start getting heated when United States yields start hitting 5% and 6%. But we'll get to that. Now we still see massive spending and massive expenditure, and this trickles down. Now we are going from a global scale, and we'll go to the Eurobond before going to the domestic, because the United States is one of the places with the highest capital. So we try to make it quick. One thing important to note is the DXY. So Trump policies came, and Trump policies were supposed to position United States as a global hegemony again, and try to push the dollar index downwards and create export opportunities and make United States products cheaper. And he did that. We saw the DXY trend from as high as 102. The DXY is a chart that shows United States with its global trading partners, and we saw it fall from as high as 102 to trading around 97, which is a huge increase. We saw emerging countries actually benefit from this downward trend of the dollar, but we'll get to talk about that much later. So based on these factors, we think that the fear of recession for the United States is far off, and we think that the United States is going to end the year with a 1%, around 1% growth. Now, the proposed cuts of the proposed tariff cuts and the massive government expenditure is going to propel this growth and make the United States elude the fear of a technical recession. We also forecast that inflation fears is still something very present, and we could see the inflation figures hit or exceed the 3% marker. And for cuts, well, now the United States monetary policy is now dicey because there's a question of independence of the Fed. But anticipation and market projections, we see 25 basis cut probably by the end of the year. So moving forward, the research reports went into depth to talk about hegemonies and the shift of the global structure. Now, one thing we have noticed is the declining share of the US share of global capital. You see, the United States was able to mount up their gold reserve by maintaining a surplus, but this surplus was hard to maintain post the World War, and we've seen it decline massively. And we have also seen people like China actually take a large portion of that share. But it now looks, and the question that was answered in the report was, what is the next phase of hegemonies? The hegemonies has come from the Roman Empire to the British Empire, and now we are living in the United States hegemony. So one thing the report tried to ask and question was, what are the parameters and what is the next step? We see that the US debt is growing 120% and is still growing massively, and the Build Beautiful bill is expected to add a little bit of more money to that growing debt. Trade deficit is also growing. Like I said, before the war, before the Second World War, the United States was almost at a surplus, right? But after massive exportation of massive exportation, we saw that pushing the narrative of the United States economy, we saw that that trade deficit could not hold, and which means Trump is now trying to do something new. Trump is trying to flip the script and see whether this global power can actually be maintained. But what's next? The good question might be, will China come and take the reins? Our analysis shows no. It's actually the dawn of the multipolar world. So the first conference was had in the Bretton Woods conference, where we had the currency pegged to the gold, which we had the initial gold standard. And we know in 1970, Nixon removed the gold standards to make the fiat currency. But now there's a revolution of a multipolar world where commodities lead the way, where instead of having just gold or fiat currencies, we're having commodities like oil, like cocoa, like cassava, like things that can actually push and help the AI revolution and things that really matter. So there's a quote that if you have all the US Treasury and all the dollars and you cannot get that money to actually buy food, it's what use is it? So it now makes people start decoupling from this global interconnected scale to start thinking of creating a self-sustained economy and creating a self-sustained world. So this is what our research tried to push us to. And in the global stock market, we saw the volatility that we had, and we saw that some asset class have actually done well post the volatility during the April recovery, while some are still going forward. Now, one thing we notice is that United States companies that have high export potentials have actually done well as the dollar has been reducing. Remember, we saw the chart of the DXY. Now, companies that actually have high exposure for export outside the United States have actually benefited from a lower dollar. So if you guys are looking for opportunities or the next place to make your money, that is actually a place to look at. Now, our estimates, the United States S&P 500 has tried to exceed 20%, going on for 6 times, almost six, like 5 times in a year along the last couple of years. But our outlook right now is going to see that it's going to find it a little bit difficult to exceed that mark going forward. So let's go to the Eurobond. We have already spoken about our estimates. We've talked about market estimates. We've talked about the Fed interpretation, looking at the dot plot and looking at least one or two cuts going out to half year. But this is a very slim chance. If we see the end of 2025 without no cut, it's still going to be accepted. On the Eurobond space, we have the reserves doing very well. We have Moody's, other rating agency uplifting Nigeria, and the CBN governor yesterday just alluded to the fact that the reserves have just hit 41 billion as of July, which makes Nigeria a very favorable country for foreign investors to actually push in capital. And we have seen capital inflow move directly to our country as the CBN maintains the interest rates at this level, and the outlook of the Americans is to reduce their own interest rate. We see capital flow to where there is actually chance to make money. And Angola has actually seen it, which have actually left the OPEC. I've seen a little bit of trouble meeting their projected oil capacity, because Angola is another oil country that benefits from the global oil prices. But because of the dilatation of their oil wells, they have not been able to meet up the capacity. Yes, the bonds are actually bullish, but there's also going to be caution. South Africa is actually doing very well and holding a much of gold reserves. Their countries is primed for another emerging market hotspot when you're looking for where is the money in the next Eurobond market. Now, for alternative assets, the Bretton Woods 3 emerges the view of the multipolar world, the view that the fact that commodities might be the next big thing. And we've seen that commodity prices have been off the roof, particularly gold and other commodities, given the sanctions and the lessons people have learned from the war in Ukraine. And so we hold this steadfast. Another thing we have seen is that Nigeria can actually benefit by investing more in the agricultural sector and investing more in the commodity space. We have seen that even things as little as water can be a scarce resource because the increasing demand of AI and the increasing demand of computing. So the water resources, the commodity resources is definitely a hotspot for our emerging times. Rethinking the whole natural resources, thinking of ways to actually self-sustain would be the next big picture for the Nigerian economy. So moving on, since we're spoken about gold, we're talking about how these commodity hotspots have actually emerged. Now, the cryptocurrency is a huge thing. So we have seen that corporate holdings have increased over time. We are seeing corporate holdings almost close to 900,000 bitcoins for corporate holdings. And if you look at the chart to your left, there's something different about this rally. We see the rally of cryptocurrency like Bitcoin and Ethereum rallying, but the volume has actually not been the same with other rallies. You know, see, we see the volume a little bit mute, leading us to believe that this is more of patient capital coming to the market. Now, Bitcoin is no more seen as a Ponzi scheme, but with the backing of people like Goldman, with people like BlackRock and Vanguard, they are seen more as a stable currency. Now, the DG spoke about the tokenization of assets. This is something that the foreign worlds are actively working about and talking about it. So it's no more seen as, oh, it's just a quick way to make a quick bucks, but people, even with a decline, are buying more. And the volume for this rally is showing that it's one of the lowest for any Bitcoin rally. And we see Bitcoin hitting above 110,000. No, this is a very volatile asset. This was an asset that was trading around 70,000 within the same year, and now it's trading as much as 100,000. But it now begs the question: more research needs to be there. The Security and Exchange Commission has a forward guidance for cryptocurrency assets, but yet there's still a bit of hiccup when it comes to the CBN in legislating banks in moving it forward. So looking at the influx of institutional money into this asset was a case to study in our report. Now, on the macro scale, we talked about Nigerian shocks and the ability to handle it. Now, looking at how Nigeria has gone, we found out some peculiar things, because the essence of research is the repeater of research, trying to find things and trying to find a gap to what was actually done. We saw that Nigerian experienced an oil boom, and during this pre-SAP era, we saw that oil massively dropped. And given the outlook of the OPEC Plus, we're seeing that there's going to be a continuous increase in output going forward. Now, continuous increase in output means that the price of oil might definitely be a little bit bearish. Now, bearish oil means problems because the Nigerian budget keeps the oil at $75, and we have been trying to beat our our production capacity above the 2 million barrels region. So we are currently producing around 1 million barrels plus, 1.6 million barrels plus. But something we noticed now, when trouble came and we were having an economic decline, we reached out and we got some advice: devalue your currency, privatize, reduce government expedition, liberalize trade. But yes, we got the inflow from foreign institutions, but it also led to a massive depreciation of our naira, like we have seen before, and it kind of gave us the deja vu effect. The reason why we looked back as far as SAP was because we found out that we're repeating almost the same issues. The previous depreciation was massive, almost 1,000%, and it didn't just happen at once. It went leap by leap, and the deja vu effect. We see inflation skyrocketing, we see rising prices, rising exchange rates, and this just gave us some questions to answer. is it that our macroeconomic issues have not changed from the time of 1970s? Are we not taking the policies well? What is happening? How can this be a repeat of the same thing? So we investigated more, knowing that the volatility tried to run a correlation between oil prices and reserves, and we saw that the oil prices was flexible downwards but sticky upwards, which means when oil prices go up, it was very difficult for us to add to our reserves. But when oil prices go down, we see our reserve depreciate beyond measure. Now, this took, this made us check other petrol exploration countries, because one of the statements is we have to diversify from oil and diversify from oil. But when compared to other oil nations, we see that Nigeria currency has actually depreciated the most, almost 200,000%, compared to the likes of Saudi Arabia and Kuwait that doubled down on the oil production era. And even Egypt had a favorable move to us, which made us examine. We have seen another unification, we have seen another call for devaluation, and yes, we are being praised for a unification that is commendable to the CBN president, governor, but at what cost? We'll find out. Now, one of the narrative that has been posed because of the declining dollar was that emerging countries were supposed to benefit from this declining dollar. But a comparison on a month-to-month basis shows that Nigeria has one of the lowest, if not least, benefit from a declining dollar. So even if the dollar and the DXY market was reducing, we didn't actually benefit that much, showing that we are kind of decoupled from the global space. While we saw the likes of Ghana almost benefit 41%, Mexican pesos, the euros benefit from a declining dollar. So, which leads us to our estimates. On a best case scenario, giving more international debt and inflows because of, like I said, the euro bonds and all our other of our dollar assets are very attractive, given that the posture of the United States is to reduce rates. We could see Naira trade around 1,400 for a best case scenario. For our base case, we could still see the Naira hover around 1,115, and worst case would be a $1,700. Now, we examined the rebase effect, the misery, and how it affected misery, and we also looked at the inflation figures. Now, on the best case scenario, we still see the inflation trending to 20%, and on our base case, remaining around 23. The worst case is that the inflation rises to rebasing levels, which is around 25 to 26%. But we hope we don't get there. Now, we still see rising debt to GDP ratio, and we're looking at the gap between the budgeted oil production and the actual oil production, like I alluded to. And we see that oil price is now a little bit trending downwards, with OPEC Plus having the narrative of increasing output, and supply and demand metrics shows that if output increases, prices might not necessarily, but would definitely trend downwards, because as an oligopoly, we can choose to only control one. Now, moving forward, we also saw the GDP rebase effect. Now, our projections, we had to recalibrate our projections and shave off the 5%. But we still see optimism in the Nigerian economy, and we see that probably by full year, which will probably come out next year, mid-year, we probably see a 4% move, a little bit higher, and we see that the government is going to ramp up expenditure. We might probably get to the 4% move. Now, projections are $1 trillion could probably emerge in 2025 with massive growth annually. So we need to dig into our reports to get the full breakdown. On the local equity side, we have seen massive bullish turn and increase in trading, and in March we got a spike. We saw massive foreign investors come into the market, which pushed our trade participation both for local and domestic massively high, and that was for March 2025. But there's now a hiccup. The new tax regulation shows that if you make profits or capital gain profits, you will definitely pay 30% taxes. So we kind of say this might actually affect the participation of foreign investors or even local investors into the market. After making your 10% or 20%, you need to slash out a little bit of profit. Um, we still see great prospects in the banking sector. Previous projections and previous analysis of recapitalization saw the banking sector grew almost 200% from their current prices, even though there was a little bit of hiccup as the CBN released new regulation for zero gains from FX, which was a primary source of revenue. We saw the prices of bank shares decline but recover really quickly after that. So there's still potential, and the bullish one of the banking sector is probably not over. Agricultural sector and other sectors that have faced bottlenecks on on the volatility of the Nigerian exchange rate has found a breaking point. We've seen companies like like MTN and other telcos actually increase prices and seen their share price increase massively. And the FX losses we have seen in the consumer and goods sector might start being a thing of the past as we have normalization of the market. The entertainment sector seems to be another one to be happy about. We see that the new GDP puts the share of contribution around 8%, and even though there had been some shocks, we feel that this sector has actually found a way to be resilient. Like if we have another COVID-19 shock now, the entertainment sector might actually do better than what it did the last time because of the dynamics they have made into streaming platforms and the massive revenue they are going to make from other platforms. We have seen massive inflows of movies and collaborations, and even though the annual share of growth in the entertainment sector is projected to decline, there's still prospects, and there needs to be more push and let's say more tax revenue generated from this sector in order to boost the larger economy. It's my personal view that we could find the next unicorn in the entertainment sector, but we are here to see data to back it up. So there's definitely growth in projections show that it could hit as much as 13.6 billion by 2028, and so not to bore everybody, there is our last review is for a sign of relief or data quagmire. So we've seen lots of data in the Nigerian space, and something we have noticed was to compute the misery index. The misery index is an index that has the unemployment, inflation, interest rates as all negative additions to the misery index, and growth rate as a plus. Now, computing the misery index, you will see that we're supposed to get a sign of relief, and seeing the unemployment numbers and the inflation numbers, you're supposed to see, oh well, this economy is doing better. But we did a little bit of analysis. So we charted the US natural unemployment rate, which is supposed to be a rate of unemployment where we have full employment, with the Nigeria's unemployment rate, and we're finding that there's a disparity. Nigeria's unemployment rate is around 5.3, and the rate of full employment is around 4.4. So are we saying that we are fully employed? Are we saying that this is what we are in Nigeria? Should we start clapping for everybody? But so it led to our investigation. We needed to know whether this was a data quagmire or we are going to the next stage. So we decided to do some questionnaires, asking people how they felt rather than just looking at the data. And significantly, even though inflation was supposed to be a gauge of the rate of increase, we saw that there was increased hardship according to our questionnaires. There was increased hardship. Food inflation became a huge burden, and people complained about the majority of their income being spent on food, having difficulties to get some of the major amenities. But something fascinating, aside from all the kind of depressing questionnaires and that depressing results we had, was asking about the future. And we found out that most people still felt that the Nigerian economy was very optimistic and things were going to get better and significantly improve next year or the coming years, which meant hope for the future. So, to conclude, the report is a massive document that I implore everybody to dive into and drop your emails if you have not dropped to the report. But it shows that with all the hiccups that has been happening, there's still resilience in the Nigerian economy and there's still hope from the future. Not just for me. That's what the data says. Thank you.
Thank you so much. Please put your hands together one more time for Dr. Ifeanyi Uba.